Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of Understanding Bond Duration, a key measure in investment strategy. Understanding bond duration can help to protect your investment and boost returns. In the ever-changing world of fixed income investing, knowing how long it takes for a bond to repay its true cost is key. Bond duration measures this, serving as a key indicator of a bond's interest rate risk. If you're new to bond investing or looking to deepen your knowledge, this video will break down the concept of bond duration, its importance, and practical ways to use it. By the end of this read, you'll be better equipped to make informed decisions and optimize your bond investment strategy. This will help you better align your portfolio with your financial goals. What is bond duration? Bond duration is a measure of how much a bond's price might change when interest rates shift. Think of it as a bond's sensitivity to interest rate movements. If you're investing in bonds, understanding duration can help you figure out the risk and potential reward involved. It's a crucial concept for anyone looking to manage their portfolio effectively. Types of bond duration. Several types of bond duration can be used to understand the sensitivity of bond prices. Here are the most common ones: Macaulay duration, modified duration, and effective duration. Each type offers a unique way to look at the bond's reaction to interest rates. Macaulay duration. Macaulay duration is the weighted average time until a bond's cash flows are paid. How it works. This measurement considers the time you'll get each payment, using the present value of each payment to give weight. In simple terms, it's like calculating the midpoint of all the cash flows you'll get from the bond. Purpose. It's mainly useful for understanding the timing of cash flows and the overall interest rate risk. Modified duration. Modified duration adjusts the Macaulay duration to give a more accurate picture of interest rate risk. How it works. It shows the percentage change in a bond's price for a 1% change in interest rates. It modifies the Macaulay duration by taking into account the bond's yield. Purpose. Modified duration is a more precise tool for measuring price sensitivity compared to Macaulay duration. It helps investors understand how much a bond's price will move when interest rates change slightly. Effective duration. Effective duration takes into account the possibility of changes in cash flows due to embedded options within a bond, like a call or put option. How it works. It measures the sensitivity of a bond's price to a change in interest rates, factoring in the potential changes in cash flows. This is crucial for bonds that aren't straightforward. Purpose. Effective duration is especially useful for bonds with complex features, providing a more accurate measure of interest rate risk. Understanding these types of bond duration can help you make smarter investment choices. By knowing how sensitive your bond investments are to interest rate changes, you can better manage the risks and rewards of your portfolio. Why is bond duration important? Bond duration is a crucial concept that every bond investor should understand. It measures the sensitivity of a bond's price to changes in interest rates. Knowing the duration of your bonds can help you manage risk and make more informed investment decisions. Interest rate risk. Interest rate risk is the risk that a bond's value will change due to a fluctuation in interest rates. When interest rates rise, bond prices fall, and when interest rates fall, bond prices rise. Duration is the tool used to measure this risk. It estimates how much a bond's price will change with a 1% change in interest rates. Shorter duration. Bonds with shorter durations are less sensitive to interest rate changes. They are generally more stable but offer lower returns. Longer duration. Bonds with longer durations are more sensitive to interest rate changes. They can offer higher returns but come with greater risk. By understanding duration, you can predict how much your bond portfolio might lose or gain in value if interest rates shift. It acts like a weather forecast for your investments, giving you insight into future risks and opportunities. Portfolio management. Managing a bond portfolio effectively requires a good grasp of duration. Portfolio managers use duration to balance risk and reward. Here are some strategies they might use. Duration matching. This strategy involves aligning the duration of your portfolio with your investment horizon. If you need your money back in 5 years, you would aim for a portfolio with a 5-year duration. Immunization. This strategy aims to make a portfolio immune to interest rate changes. By carefully choosing bonds with different durations, a manager can ensure that interest rate fluctuations have minimal impact on the portfolio's overall value. Active duration management. Some managers actively adjust the duration of their portfolios in response to interest rate forecasts. If they expect rates to rise, they might reduce duration to minimize losses. If they expect rates to fall, they might increase duration to maximize gains. These strategies can help you achieve a balanced portfolio that meets your investment goals while managing interest rate risk. In essence, duration is like a control panel for bond investors, helping you navigate the complex world of interest rate changes. Calculating bond duration. Understanding bond duration is crucial for anyone who invests in bonds or manages bond portfolios. It helps you gauge your investment sensitivity to interest rate changes. Let's dive into the two primary methods to calculate bond duration: Macaulay duration and modified duration. Macaulay duration calculation. Macaulay duration measures the weighted average time until a bond's cash flows are received. This metric gives you a sense of how long it will take to recover your investment. Here's how you can calculate it, step by step. List cash flows. Write down all the bond's cash flows, including coupon payments and the final principal repayment. Determine time periods. Note down the time periods in which these payments are made. For instance, annual coupons mean you'll have periods 1, 2, 3, etc. Discount cash flows. Use the bond's yield to discount each cash flow back to its present value. Calculate the weight. Find the weight of each cash flow by dividing the present value of each cash flow by the total present value of all cash flows. Multiply and sum. Multiply each weight by its respective time period and sum these products to get the Macaulay duration. Here's an example. A $1,000 bond with a 5% annual coupon and a maturity of 3 years, yielding 4%. Period cash flow discount factor, at 4%, present value weight time X weight. $1.50 0.9615 $48.08 0.0457 0.0457 $2.50 0.9246 $46.23 0.0440 0.0880 $3 $1,050 $0.8890 $933.45 0.89042.6712. Sum of weights, 0.0457 plus 0.0440 plus 0.8904 equals 0.9801. Macaulay duration, 2.805 years. Modified duration calculation. Modified duration is an adjustment of Macaulay duration that provides a better measure of a bond's price sensitivity to changes in interest rates. Here's the step-by-step process. Calculate Macaulay duration. This is the first step, as explained above. Use formula for modified duration. Modified duration equals Macaulay duration, 1 plus yield to maturity, number of periods per year. Let's extend our earlier example. Macaulay duration, 2.805 years. Yield to maturity, 4%, 0.04. Number of periods per year, annual coupon, 1. Modified duration equals 2.805, 1 plus 0.04, equals 2.696. In this case, the bond's modified duration is approximately 2.696 years. This means for a 1% change in interest rates, the bond's price would change by approximately 2.696%. Understanding these calculations not only helps you evaluate bond investments but also aids in managing interest rate risks more effectively. Once you've got the hang of these calculations, you can make informed decisions about buying or selling bonds. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.